All right, let's try this sound check. So a few times this week I've tried to catch this subject, but it's either been wrong time of day, interrupting another schedule. It's why I come in a lot of times at lunch. During the lunchtime, nobody is scheduled to be streaming, and we have a live market. We can look at things, and there's really nothing to trade through that lunchtime. So it's a way for me to come in and kind of answer some questions to help people with some of these basics. There are major flaws when looking to trade options, and it's not your flaw. It's not a new trader flaw. It's an idea that you can't see these things changing on a graph. So a lot of times when I'm trying to help a new student trade options, I tell them to chart the option that they're looking at, not for entry and exit signals, but to kind of get an idea of the way that that option's value is going up and down in a day. Because options are not stock. When you buy an option on SPY and SPY moves $1 and then it hits a range, support, or resistance and it stops, that option, the value of that option doesn't stop. Price stopped, but that option suddenly drops drastically in value or perhaps starts to tick up in value while price is doing nothing. It's just sitting at this range. And the reason for that is because options pricing comes from a lot of different factors: implied volatility, delta, gamma, all the Greeks, more Greeks than others, depending on how many days are left in expiration. But that option isn't stock. So it gains and loses value even when price isn't moving. And since this isn't, quote, something that we can necessarily chart, new traders make this mistake a lot, right? Oh, well, I'll trade this option and I'll hang on to it. And then, the product that they're trading hits a resistance level and they think, well, I'll hang on to it. Maybe it'll break through. And the longer it stays there, the less value that option has because of time or because of volatility. And then they end up having to close, whether it's because we're getting towards the end of the day or it suddenly starts to turn against them. But but so much time has gone by that trade has already lost its edge. Now you're sitting in junk and you're just trying to salvage a trade, and it just becomes a mess. So no, Arjun, I don't have a video specifically on getting out of an option at the right time or recognizing options pricing. It's kind of an acquired skill. There is a lot to trading that comes from experience. It comes from the doing. So the only way that you get better at it is by doing it. But what does help and things that we can focus on are getting in at the right time, buying the right options, right? Whether you're buying a call or you're buying a put on the intraday basis. I say the right ones, but that's not really the right language because it's not like you could pick, quote, the wrong one. But picking the one that is the best for your current trade logic, for your goal, for your account, for your skill level. All options are not created equally, and their success or how much money they make on a day is not equal. So if I trade the 279 call with 10 days to expiration in SPY and SPY makes a $4 move on the day, that call will make less money than the call that if I'd have used a 5-day call. I could use the exact same strike. I could get in at the exact same time, get filled in both. SPY makes a $4 move and I close the trade. That one farther out in time will make less money. It is also more risky. Notice that this 7-day series has more liquidity than the 10-day series. That matters, right? Supply and demand. So a lot of this stuff, when it comes to options, it's not necessarily an options thing. Supply and demand is a trader thing. You should have a basic understanding of supply and demand, right? Since a lot of us are new. Perhaps you don't, but that just becomes one more thing to learn, one more thing to put on the list. Uh, right here towards the end of this discussion, there was a question about getting out of SPY at the end of the day yesterday. When would somebody have covered this trade? Great question, by the way, and I think Lucien did a really good job on it. It's not for me to tell you how you should manage your trade, but it is up to me as a member of the Bullish Bears to point out 4 different ways that you could typically manage trades, and then you use the one that fits you best, right? Because I'm not here to tell you, right? Oh, well, you should use a trailing stop. Nah, maybe you should, maybe you shouldn't. Oh, well, you should already know where you're getting out. Hey, for someone like me, that's really easy. I know where price is going, right? If the family goes to the grocery store in 2 different vehicles, I don't need to know exactly which direction they're going. I just need to know that they're going to get to the grocery store. Well, it's kind of the same way when I take a trade. I know where price is going. It's the reason I take the trade. If I don't know where price is going, I just don't get in. No problem. Easy peasy. But that's not so easy for a new trader. So if I was to say, well, why didn't you get out where you knew it was going? Your answer is probably going to be because I didn't know where the hell it was going. I kind of knew it was going short. That's why I went short. But where do I get out when it's no longer going short? Those are crazy answers, right? That doesn't help anybody. But there are 4 standard ways to close a trade. Price, say you want some kind of risk reward ratio. Well, I risked $1. It moved 75 cents so far, and I made my 2-to-1 risk to reward ratio, or I made my 0.5 ratio, whatever it is, and you close the trade. There's nothing wrong with that, but it leaves money behind sometimes, and then you don't feel good because it kept running and you got out of a good trade, right? Uh, so then you say something like, well, I'll use a stop, but then the stop wicks you out maybe somewhere right in here, this 276.5 range. You get stopped out 277 and you say, damn it, that stop was too tight. It kicked me out of a good trade. Next time I'll use a looser stop. And then, of course, the very next time you try that, you end up losing way more of your profit. You end up getting a scratch on a trade that was good, right? So there's no perfect answer on exiting trades, but we can build some trade logic and try to use our journal to adjust what we do. Journals are not about recording what you did today. Not today, but if you took 3 SPY trades and 2 Q trades, and then you had an IWM trade and you journaled, these were winners, these were losers, these are where I got in, these are where I got out. Hey, that's great for taxes, but that's not going to help you become a better trader. You need to be journaling what kind of trade you took and what needs to be adjusted next time. What kind of exit did you use today? And did you like how those exits worked out? And if you didn't, what did you not like and what could be adjusted next time, right? You could have traded this with fib and you could get out at fib exits. A target necessarily isn't so hard to develop even for new traders. And remember, nobody knows where the bottom is. Even when I say I know where price is going and I'll get out there, even I don't know where the bottom is. I got a really good idea and I want to get out before it gets there because I know that I'm not perfect and I'm not going to nail it right on the button, but I can get it pretty damn close. So I'll just get out before it gets to where I believe it could pivot. But you can use your drawing tools, and perhaps you've seen Rose do this. Here was the first impulse. It finally had a pullback. You use that impulse to measure your next leg down. Imagine that it worked. You take that impulse and you measure, too low. You measure your next target down. So as you can recognize, we can get a very strong zone of where we should be getting out at. All right. And then you just have to make that decision. Am I going to be that risky person who really wants to get the very last nickel out of this? Or do I get out early? And remember, when that option, because we're trading with options, when it starts to get into a consolidated zone, its value is going to change drastically, even when price does not. Right. So once it reaches this new destination and begins to run sideways, that option starts to change its value very, very quickly. It might be in your favor, it might be against you. But when volatility decreases, so does your options value. And when volatility increases, so does your options value. One way that you can see intraday volatility is to use the Bollinger Bands. I'm not suggesting you run out and put Bollinger Bands on your charting platform, and I'm most certainly not suggesting that you try to enter and exit off of band touches or crossovers, cross downs or cross ups or anything like that. But if you look at the Bollinger Band, more of kind of like how you look out the window to see what kind of day you're having. Is it a rainy day? Is it a cloudy day? Does it look windy? Right? You don't just sit there all day staring out the window trying to figure out what's going on with the weather. You just look out, you kind of get a feel for it, and then you're done. You're done looking out the window. You've got a bias about what kind of day you have. The Bollinger Band is a great way to gain bias about the current market conditions. Is the volatility contracting? Is it expanding? What is the direction of the volatility? When I zoom in for an example right here, you could see where the Bollinger Band suddenly pivoted. It was contracting, contracting, contracting. Oh, now it's expanding. Right. So it's just uh, a measure of your own bias to be able at a glance to say, oh, look, the volatility is compressing. Right. You can get some edge in that. We want to buy options when we're day traders, right? We don't sell naked options, but we can buy calls or buy puts. And if I buy a put right before the breakdown, notice the expansion in the volatility. That put gained value right away. It like blowing a balloon up. It expanded in value, not because price moved very far, but because the volatility expanded. It increased the value of our puts. Sweet. That's what we wanted it to do, right? We bought it. We have to sell it. We want to sell it at a profit. When price moved in our direction, that helped even more. When it started to squeeze, it lost a lot of value right there. A lot of value. Price didn't reverse even halfway back up from the move, but I would bet that that option lost half of its value in that squeeze of volatility right there. So being able to recognize these subtle pieces of the puzzle are critical if you're going to day trade, that it's not just about how far did it move. It's about being able to get out when you still have the Greeks on your side, or being able to recognize a good time to get in, not just from price, but because of what volatility is doing. A lot of that comes down to picking the correct option to trade to begin with. Now, a lot of people, especially in the current market, these options are so expensive that they are going farther out of the money because it's what they can afford. That's a really, really bad idea. So there are, quote, proper options to choose from. The options that are going to make you the most money with the least amount of risk. And then there are options that are not really a good choice. And there are reasons to use these way out of the money options. There are strategies to use these way out of the money options. But if you're going to day trade, most of your strategies won't use any of these. And if you try, you will be disappointed more often than you would like to admit. So just because these are the only ones you can afford does not mean they should be the ones that you're trading. I try to encourage people to do best practices, to trade the right strikes because they're the right ones to trade. And that if you can't afford to get the ones that are the right ones, then perhaps you need to find another product. Since the market is so highly correlated right now, when you're watching SPY, you could be watching the XSP, the SPX, you could be watching Apple, you could be watching a multitude of products out there that move in step with SPY. and it might be a $30 product instead of a $278 product. So it could be cheaper options for you to trade. It would move in step with SPY. It would have the same type of volatility, probably not as liquid, but it would be something that you could afford to trade, right? And even be able to get multiples. That was always one of my biggest problems. When I was trading options, I would look at something like Amazon, and it would be one of those days where Amazon was having a really good trade setup, and I would go to trade the options and damn near choke on it. You look at and of course Amazon's a lot cheaper now than back then, but these are $3,000 options, for goodness sakes. I need two at least so that I can fade into or fade out of my strategy. And then I go and I look at this and well, what the hell am I supposed to do here? You know, take a day trade with $10,000 just for 2, 3 options. Ouch. That doesn't work out too good for me. So I don't get that opportunity. And I would end up having to trade Amazon in a spread instead. Day trading a spread, it's okay. If I do it, it needs to have a high ATR. It needs to be worth my while. And Amazon had days when I was day trading options where, it would move $75 or $100 in a day. So more than enough room for me to be profitable. Remember, for all of you who are day trading options, don't just look at your one single chart. So if you're trading SPY, don't just watch SPY. You're blind. Pay attention to what's going on in the market. So if you're looking at SPY, look at QQQ, look at IWM, look at DIA. You should have a 4-grid set up. Now these are futures, but I could just as easily put SPY, QQQ, DIA, and IWM in here, and then I would be watching the 4 markets. If you are only looking at your one single product, it's like putting your hand right up to your nose. You might be able to see around it a little bit, but you're pretty much only seeing your hand. And if you're only looking at your one product, SPY, for an example, what the hell is the rest of the market doing? SPY is not an individual thing. It's not even its own thing. SPY is Facebook, it's Apple, it's Microsoft, it's Google. And so its underlying is the S&P 500 index. And we can just look at Market Watch and look at the S&P 100 and realize that SPY has all of those products in it. Now it's weighed, so they're not equal. It doesn't have the same amount of Facebook as it does Costco, but it has all of these in there. They're all represented in SPY. So if you're going to trade an index ETF, have an idea of what it's representing, right? Like if I'm going to trade the Qs, we look at the Qs like the tech industry or the tech sector or the tech index. So that would be geared more towards the Microsoft, Google, ads, revenue, computers, media. And if it's the Dow, then we know it's 30 stocks and it's all the mega cap companies out there. All right. So if I'm trading IWM, the Russell, then I'm going to be thinking more about banking, finance, small cap companies. So don't just look at that one thing that you're trading and think you got it all covered, because SPY is going to react to what's going on in the marketplace. SPY will not drive the marketplace. It gets driven. Might as well keep your eye on what is driving the market so that you can see what is going to happen to SPY before it happens. Adding market breadth, tick, trend, AD, that helps, gets some perspective. keeping your eye on the sectors in the day so that when you start to see a sell-off like this happen, you can ask yourself, what is not participating in this move to the downside? What sector or industry is holding us back from a real good sell-off? I mean, this went from 281 down to 276, but it could have easily went to 271. Why did it not? How come it didn't move faster to the downside? What sector was holding us back in this move down? And when they all start to participate, then you really get some good moves in the market. Understanding why, watching to see when they do finally turn and move together. Correlation, so cumulative tick is another way. That's more of the market breadth. Knowing that the entire market is moving with you and not against you is a really good way to do business. What else you guys got? Oh, 15 minutes, maybe 10 minutes. Not very long, Alan. I mainly just hopped on to answer some questions that I seen thrown at Lucien earlier. Yep, still going to do a toss class today. I'm not necessarily, I don't have any subjects planned. Don't have anything to bring to the table. More of the idea that I'm going to be here for people who have problems with their think or swim and help you guys resolve whatever that problem is, so that you know, maybe it's a charting thing, maybe it's a color issue, maybe it's a how do I get this darn thing to work, you know, whatever it is. Can I draw fib retracements on Apple long-term 4-hour chart or a 1-day chart? Sure. A couple things to kind of go over with fib. Nobody knows why it works, right? I mean, we know it does, we just don't know why. Nobody knows why. Nobody has ever been able to figure out why. So if you ever go and you watch a video about Fibonacci and there's somebody telling you that you have to do this and you can't do that, you got to kind of ask yourself, like, the hell do you know, right? So when I was trying to learn fib, I went to one video and they said, always draw from the top to the bottom. And that if you don't do that, you're doing it wrong. And that you can never stop somewhere in the middle, right? What if I only wanted to go to the 2018 low? The video said, no, don't do that. You're wrong. No, bad. You know, top to bottom, top to bottom, top to bottom only. And so, all right, you know, I worked on it, I studied it, and then I found another video like 3 days later, and it said, go from the bottom to the top. Never from the top to the bottom, only to the from the bottom up, and you know, only measure the one that you're from the next impulse, and basically just completely contradicting what the other person said. And I was like, well, what the hell? You know, both of those were not super big names in the industry, but recognizable names. And they were each contradicting each other. It's okay, look, you both can't be right. And obviously you both can't be wrong because you're both profitable in what you do. So like, what am I supposed to do? Right. You are each contradicting each other. So eventually I kind of got to the idea that since nobody knows how it works, what if I just start trying a couple things, and does the results speak for themselves? So I started to do that instead. And I came up with my own set of rules. And my rules are to stay consistent that how you analyze this is key and that you don't want to change it. Now, one of the reasons that Rose is so successful in what she does is because she doesn't change, right? She is consistent. And that is one of the biggest things about being a trader is to stay consistent, that you don't jump into a trade and suddenly change your mind or move your targets or fear and greed. You do things with repetition and consistency, and that is one of her finest attributes. And I can never give enough praise for that. It is. Yes. And so it really doesn't matter if you go from the top to the bottom or from the bottom to the top. The measurement is the same, but you will see some videos that say, look for the pullback to the 618, and other videos that say, look for the pullback to the 382. Now, it's the same measure of pullback, right? But a newer trader would say, wait, I'm completely freaking lost now. I need to wait for it to get all the way down here, right? And see how that can be. It just jacks everybody's mind all up, right? So uh, understanding these Fibonacci numbers comes down to the math, right? 50 is always 50, whether I drew it from the top or the bottom or not. The 618 pullback is the same thing, as the 382, or the 236 is the same as the 786. So, just being able to recognize that pullback level and then reading it consistently. So if you are going to intraday trade and you want a target on where we're going, right? Because that's kind of the key, right? And we were just talking about having a target to get out. You can use the Fibonacci for that, and it's beautiful. I love it, and it's very, very successful. But if you're in a good, strong trend through the day, that 1, 2, 3, 6 up here will get stretched so far ahead that it's an unrealistic target, and that becomes uh, arbitrary at that point. We need a target that we can actually reach, right? Whether it's to add in or to get risk out, maybe get some money out of the trade, lock in some profits. But if we don't move the base and we just keep moving the peak through every new shift higher and every new leg up higher, that 1, 2, 3, 6 gets expanded so far away, it becomes this unattainable target. And then it starts to fail us. And then we start to doubt the Fibonacci. Instead, I recommend people to get very comfortable with Fibonacci and get comfortable moving intraday, moving that thing. So we can just pick a day and zoom in. And I've done a lot of work on this exact thing. Starting out the day, getting the first run, which would be the open range. For those who are unfamiliar with the open range, go do some more work on that. But this gave us our open range. We had a pivot low, we had a pivot high, the market ran sideways, and we're looking for a Busby. We're looking for a Busby, meaning we're looking for price to come back down and validate that 100. Now, we don't need anything in the middle here, so we can just kind of clean up the Fibonacci a little bit and get rid of the distractions. So we've got our 100. And if we use the hard right edge and we dial this into a different time frame, yeah, let's do. Actually, I better not change that because I don't know how many days back I went. There we go. Our open range would be right there. We got the 786 pullback. We've got an overhead target. We finally get the break right there. Now, at this point, you got a choice to make. You can move that Fibonacci base or you can just move the Fibonacci peak. That wasn't the base right here. So that was the next breakout. So when you do it, just do it and then look at what size the next 1, 2, 3, 6 is at. This is the arbitrary side that kind of comes with experience. Once you move that peak from here to the next break up, look at where it sets that next 1, 2, 3 and ask yourself if that is too far away. That's arbitrary, right? What's too far? Well, if you're trading something like Apple and it has an ATR of 75 cents and then the 1, 2, 3, 6 gets placed $5 away, that's too freaking far, right? That's an unrealistic expectation. So at that point, you would want to grab the base and move it. Now, you can see that it didn't set that 1, 2, 3 too far away. In fact, that's exactly where price ended up going, almost to the penny before it turned around and came back to the 100. Now, once it reached that, we would move it again. And then we'd have to ask the same question all over. Are we reaching too high? Is it too far away? Am I asking for too much out of this market? And again, if it looks like it's too big of a distance, and that just comes with experience, you're going to want to move the base. The good thing about Fibonacci is you could have already moved the base anywhere along the line. And the more you do it, and the more you get comfortable with it, you'll get to the point where you'll begin to move it, and you'll say, oh, well, I was going to move it, but well, that looks too small. I guess I'll put it back. And it's okay to do that. It's okay to throw it up there and say, nah, I don't like it, and then back away. Notice when I did move it. Notice when I did move it and I brought it up to these lows, right? Any of these would work. Could be here, could be here. Notice where the next 1, 2, 3 stopped at. It's not arbitrary, right? So some of this really will only come from the doing. Some of it comes from having choices, or at least understanding that you can fiddle with it and not break it, right? So on the intraday, when you're looking for your next leg up, throw that Fibonacci on there and then ask yourself, is that an unrealistic target, right? I mean, I could be on a penny stock and, say I throw the Fibonacci up there and then the 1, 2, 3 is $1.50 away and we're looking at a 75-cent product and you just sit there shaking your head like, I know that this thing ain't going to make 120% move today. I'm going to need to move that base up. The more you use it and the more you get comfortable using it, sticking to some of your rules, the better you'll be. And you can use the little sidebar, use the scratch pad, maybe put in your rules, that I'm going to go from base to peak. When you get to a point where you need to make a choice, make your choice. I'm going to move it. What did you do? How far did you move it? Why did you move it there? And keep track of that. Eventually, you will be ingrained and you'll just be doing things naturally, right? You won't even think about it, like putting on your seatbelt when you get in the car. Sure, when you get into a new car or a different vehicle, it might be something that you actually pause and think about. But when it's yours and you've been traveling around all day and you keep getting in and out and you're just automatically putting on that seatbelt, starting the car, and you're not thinking about it. It's just natural. You'll get that way with Fibonacci, but it takes the doing. All right. And you can, like today, the market's closed. You can go back and ask yourself questions like, well, what if I only drew it from here to here? Does that typically work out pretty good? Maybe I'll go throw it onto Google real quick and see if that works out. But this intraday Fibonacci talk is absolutely different than these daily, weeklies, and monthlies. These, you don't need to change. You don't need to adjust them and fiddle with them. You can. There's nothing wrong with it. But in the current market, with everything pulled back so strongly, it's offered us these really great opportunities that a lot of things wouldn't have been offering us. Notice this big gap between 100 and 78. Well, Apple has been inside of that Fibonacci gap for a long time, and there just wasn't anything there. All right. So, sure, I had it on, but when there's nothing to hit, there's nothing to hit. The good thing is, if you take, for an example, and you went into the Dow 30, you go to the monthly and you tell it, give me everything you got. Now, you don't need to zoom in and get it to the penny. Just hit these lows down here somewhere. When price gets to that level, this Fibonacci is drawn from the maximum available Apple, years of Apple. And yet, when price got there, it reacted to it. And I would leave that on there. The idea maybe is to shade it in such a way that it's not in your face, or you save it on a different drawing level so that you can turn it on when you want it and then turn it right back off again. You can also do, this is a 30-day, 30-minute. You can pick your times, what I call the mapping out the charts. It's when you step into a daily candle and start to map things out. Pick one that you use a lot. For me, 30-day, 30-minute in the current market is something that I use a lot. Map that sucker, low to high on my 30-day, 30-minute. Did that offer any trade opportunities? Well, price seems to have reacted a bit at that level. Maybe we would want to color code it to be able to recognize that it's on the intraday instead of that monthly. And that way I can distinguish one from the other easier at a glance, so that I would have more trust or faith in the larger one, the monthly, and less trust or less faith. But these aren't handrails. They're not something that we want to lean on and trust. We just want to recognize that there is a handrail there. That way we can anticipate price reacting, but not necessarily trying to trade off the reaction. So if you're about to go short and you realize, oh, well, there's a Fibonacci there, I think I'll wait for a moment, make sure it actually breaks that. Or you're about to exit a trade because you see price pulling back, and then you say, why is it pulling back? And you turn on your fibs and you say, oh, it hit a fib. I guess I'll wait a moment to see how it resolves before I go ahead and close my trade, because it might break through there after all. Kind of gives you some context of why price is moving or turning. It bothers me when I don't understand why price does something, because as a new trader, you might not be able to grasp this right away. Price does not just randomly run around all over the place. It's driven just like we drive a car. So when it turns or it pivots or it changes direction, there's reason. It hits something. Something happened. I want to know what it is, because 9 times out of 10, we can find it, which means we can anticipate it so that the next time we know where it's going to turn. Maybe not on the penny, but within a dime or a quarter. Close enough for me to take a trade and get profit out of it. So where is it going to turn? Why is it going to turn there? And then if it doesn't turn, I can say, oh, that failed. Cool, that one failed. Why? And where's my next trade? And there's nothing wrong with an either or. I know a lot of us think that we need to have the answer. Where's it going to go from here? Will it break up? Well, it might, but it also might break down. So let's build a plan for if it breaks up, I'll have a long entry ready to go. And if it breaks down, I'll have a short entry ready to go. It's okay to have an either or, because sometimes we just don't know which direction it's going to go. We just know it won't stay where it is. It's okay. It's all right to just own it and say, I don't know. I have no freaking idea. I'll build an either or. So use those numbers, and there's no wrong one, right? Thinkorswim defaults a weekly chart for you. It's like a 3-year weekly. You could go and map out all of them with a 3-year weekly, high to low. when price gets to those fib levels, you should see a reaction, and it won't be the wrong one, and you'll have consistency. You can say, well, I'm going to do all my larger time frames on that 3-year weekly because it's a default right there on Thinkorswim. Or you could do the 1-year daily, and you could say, well, I'm going to just go through and draw all of them on that 1-year daily, and then I'll save them on their own fib level, and I'll make them shaded enough to where they're not in my face, distracting me in my trade, and I will be able to anticipate a reaction in the marketplace from that and get a trade opportunity. Yep, and on this one, the extensions, I've seen a lot of videos out there, and it's all about plotting that next leg up. Now, the one that I was using already had it built in. These might not line up to the penny, but they'll be pretty close because I didn't zoom in and get it right to the tightness. So a lot of the videos out there, they'll talk about putting on your fib extension and that your target is the 618. Well, my target is the 1236. You see how it has the extension already built in? I have the next leg up in my Fibonacci, and I didn't have to worry about that red one, that arbitrary 3-click. It's got three pieces of the pie that you have to have if you're going to use the extension tool, this tool here. It requires 3 pieces. Mine only requires 2, the top and the bottom, unless you want to get tricky and use the middle somewhere, right? But you get to choose. My extension is the 1236. This extension, the videos that I've seen, target the 618. Well, I didn't try to get it perfect, but look at that 618 and that 236. They're the same target, right? So the extension is all about trying to figure out where that next leg up is, and I just use one tool that does both. Yep, and that's all that you have to do, right? So if we're looking at this and it gave us our high right here, we'll use the hard right edge, right? So we'll just pull the chart over. This is what we have so far, and we're thinking, man, I'm going to go long on this. After the pullback, what's my next leg up? So you use the Fibonacci, and your 618 takes you right back to the top of structure. Surprise, surprise. Imagine that. So it's not really to the penny that we're worried about. It is, where am I looking to get out of this trade, or where am I going to get risk out or something? Where's my target, right? The 618 targets you right at the top of structure. That's perfect because we would want to get out before we hit structure. But what about my fib? Since I just want to use one tool and be consistent. Well, I could use this one. 1236. Well, that also put me right up at structure. So again, recognizing the same thing, I would want to get out of my trade before it hits structure, or I would be prepared to go short when it hits that and pulls back, or whatever strategy I want to use, right? Either one of those tools on the Fibonacci is trying to help you plot where the next impulse is, so that when price, imagine that, when price goes up, what does it hit? Where does it pull back? Where should it consolidate next? Yep. So for me, I'm always trying to figure out where price is going. I want to know where it's going so that I can determine how much of the trade should I anticipate getting, and is there enough in there to make it worth my time? You can add, guys, look at my Fibonacci. I've got numbers in there that you don't have. I've got a 70 in there and I've got a 30 in there, and I use them for very specific pieces. Now, I also at one point had one here, the 11 something, and it was like a midpoint in the middle of my target. It was like a 50%. It was a halfway to target. You can add whatever you want, guys. That's the beauty of it. Use this as much as you want. That 7-0 is an entry target for me, but it's more of a swing thing. It has not really a whole lot to do on an intraday basis, but there's a reason for the numbers that I have, and I use them. Good morning, Bullfighter. There's a lot of things about algorithms that we don't know, right? We only get to know what they when they sell an algo and they buy a new one or they build a new one, and so we get to know about the outdated crap. Um, Most of the algorithms are built that we know about. There's so many different kinds. There's day trading algorithms. There's second by second algorithms. There's tick algorithms, strangles, specific options algorithms that just sit there and trade strangles and straddles. Uh, there's some that just run delta. It would not surprise me to find that there is some kind of algorithm that looks at Fibonacci. But remember this, most of your algorithms don't use charts, which means any indicator that you're going to use for candles, an algorithm wouldn't use, because an algorithm doesn't look at candles. Wall Street doesn't use candles. The stock market, the New York Stock Exchange, they don't use charts and candles. Any indicator that you can think of that uses charts and candles, they're not using that. And that's not to say that there isn't one out there that does, because algorithms, when you use a stop, you put on a trade and you put a stop on it, and you used an algorithm. You made your own, just like that. A trailing stop is an algorithm. So is there a Fibonacci algorithm out there? More than likely, but I'm almost positive that JP Morgan and Goldman Sachs and Wells Fargo aren't using it. The firms out there don't trade candles. Yeah, but we are a raindrop in the ocean, guys. We are insignificant. Now, granted, if you're trading some 25-cent stock and you're the only person trading it, you might affect the value of that stock. But when we're talking about, for an example, anything in the Dow, you are completely insignificant and you do not affect the market in the tiniest bit. You don't exist to the market. They don't care about what you did or didn't do at all, other than the fact that they build algorithms to hunt you down. Right? So they will deliberately hunt your stops and take you out of the trade. They're designed to do that. So you're just a donation. I'm scrolling through this chat here because I have a certain section in mind that I just kind of want to bring up, and I keep it around as a reminder for people. I went and specifically looked at like Apple or Microsoft. I can't remember which one. Right here, institutional trading example. The Microsoft holdings right now, and actually it was from the last Microsoft earnings, because they have to report these things. The Vanguard Group as a company owns 100,000 million, 623 million shares of Microsoft. That's $98 billion. I promise you, when they want another 1%, of Microsoft, they're not going to give a damn what price it is. They don't care that it's in a pullback. They don't care that it was at structure or that it was at Fibonacci. The only thing they care about is, can I get filled and actually get my 1%? It might take them a week to get it. And they'll more than likely use the VWAP algorithm, because they'll call a firm and they'll say, hey, hook me up with another 1%. And the firm will say, all right, we're going to get you in at a 0.3% of VWAP. Perfect, good enough. And it just gives them a ballpark figure, right, that they can anticipate it's going to cost them X amount of millions of dollars. They don't care about support, resistance, momentum, trend, pullback, Fibonacci. They just want to know they're going to get their 1%. BlackRock, another firm, 515 million shares, $81 billion. When they go to add to their position, they're not going to give a damn about what the chart looks like. Support, resistance, momentum, trend, VWAP, Fibonacci. They don't care. They've decided as a firm to increase their holdings on Microsoft by X amount of percent, and that's what they're going to do. Is it a normal news feed? Well, if you're asking if it's something that you can go and look up, yes, absolutely. So your most basic, and I mean the most basic thing out there, you can go to like just Google, right? Microsoft. You got a Microsoft market summary. And I mean, honestly, I didn't even try to go hunting for something in particular. Uh, Start to scroll down. There's your quarterly financials. And when you follow up on it, more than one of these is going to get you to a point where it says this is their holdings, this is how many insiders, this is how many institutions, and it's all out there. They have to present that to the public, and it's normally presented at earnings. I believe when I got that information, it was because I went to Microsoft market cap. And I got it from Yahoo Finance. So of course, now that I'm just jumping around, it doesn't want to show us. Just give me what I want. And the nice thing is you can see which firms are most holding that company. You can see how invested they are in it, how many have changed their position recently. Like, did they decrease their share size by X amount of percents? Why is it not giving me what I want? Probably because it's on finance. Yeah, finance, Yahoo, Microsoft Finance. Now, if you've got something like Interactive Broker or TD Ameritrade or something like that, you can get this same information from your own broker. But scroll down. Well, let's see which one we want here. I believe it's in financials, but it might be holders. We'll go to holders next. Give me holders. Give it to me. And then, the number doesn't change, right? So until their next earnings, these will be the numbers. So there's the Vanguard Group, first one on the list, and there's their share size. They last reported December 30th, 2019. And that's their overall $98 billion, like I was saying, right? I kind of rounded a little bit, but now you can see, depending on where you go or if it's a free site or not, some of these kind of report on the side or on the sly or in the shadows, and they'll let the community know, or the institutions out there can keep track and say, oh, look, State Street just sold off 4% of their Microsoft holdings. You hear it about Carl Icahn and Warren Buffett all the time, like, oh gosh, look, Warren Buffett just sold all his American Airlines stocks. it might not be reported in something like this until a set time period, but people know about it anyways, right? You got to kind of search the news for it. So the main point here is that we are insignificant to the trading community. We don't affect Apple as retail traders. We want to know what's going on with the big firms so we can ride their wake, right? A rising tide lifts all boats. So instead of fighting the trend, we want to ride with the trend. We want to move with the institutions move. Now, I do have Investors Business Daily, and I have Benzinga Pro and Black Box Stocks, and you can get more by paying more, but at some point it just becomes information overload, right? There's only so much you can do with so much. I don't know why I went there. Yep. So it's all a matter of perspective, right? Just recognizing that a lot of how we see the market, it's not how they see the market. It's not how they trade the market. So when I say that, we want to see analyst upgrades and analyst downgrades or target recommendations by an analyst, it's not because we see an analyst say we're raising price target on Paycom and that we want to go trade it because they think it's going to go up. It's because when they put out that information, everybody else is looking at it. It causes volatility, right? So every day, every morning, I look at what got an upgrade, what got a downgrade, who is stepping out of it, who's stepping in, why did the price target change? And a lot of times it'll be something like we're changing our target on Tesla because it managed to put out X amount of cars above what they should have. Their services are doing better than anticipated, and we're increasing our price target on Amazon, and we're taking it from hold to buy. Right? It'll be something like that. I have no interest in necessarily quote trading Tesla, but I would have it on watch for a trade opportunity because that stock that day would become more volatile. And the word volatility is just a fancy way for movement. So if it has an anticipated movement today, I want to watch it for a trade opportunity today. Right. So it goes on my watch list, something that had an analyst upgrade, a downgrade, news, a change in price target. But you take a company like Investors Business Daily, for an example, and you go and look at Microsoft, and it's going to offer you all kinds of news and information about it, not just some article that might have came out, but their own recommendations and their own rank, right? This company has its own ranking system, and it compares it to other sectors or other industries or other peers. And then they start to dig down into how much of the management of Microsoft is owned by insiders, or what company, what investment bank is behind Microsoft. And it just goes on, right? Because if Goldman Sachs downgrades Microsoft and Goldman Sachs is the investment bank for Microsoft, that gets my attention, right? The bank put up the money for them to be running, and that bank just gave them a downgrade. Oh yeah, I'm gonna go watch that thing today. Maybe I'll find a trade opportunity. So when these firms, you take something like Vanguard, and they've got $98 billion, they are not going to turn around and try to change their bias on Microsoft on a whim. Okay. For them to liquidate their position is going to take a long time. Days, weeks. That's a lot of shares. They would not just do that on a whim. In the current market environment, you could even consider the idea that they are still long in Apple and that they never got out and that they added to their position in this move down. One of the reasons they would go to the bank right now would be to ask for money to cover their margin calls or to be able to sustain this downdraft in the market rather than getting out of their trades, because they don't want to liquidate $98 billion of Applesoft or Microsoft or whatever, right? That they're going to hang through it. As opposed to something, for example, like Allstate, right? Who is in Allstate? Who backed them up? What does their forward guidance look like? How much of it is held by the institutions? How big is that biggest institution? When the industry decides to bail out of something that is in the Dow 30, you'll know it, right? The Dow 30, these names, you might not be able to name every one of those on your own, but when you're looking at this watch list, you should recognize every company, right? WBA, what the heck? Well, it's Walgreens, right? Uh, RTX, Raytheon, that was not in there a month ago, right? Did you notice when it did get added? Did that hit your news any? Look at the Dow, Dow Incorporated, not like Dow. And recognize that it changed, right? Because there was some kind of merger or acquisition. I just told it to show me 15 years and it didn't change, right? It goes all the way back to last May, and that's the beginning of Dow. Well, we all know Dow's been around for a long time. There was a change in ownership, a change in company. This got restructured. How much of it now is owned by institutions? These are my trade opportunities. When I find something to trade on a day-to-day basis, more often than not, it came from the Dow. Because while we can trade anything, I don't want to hunt for everything. I don't want to sit around with scanners waiting for something to cause enough ripples in the water for it to trigger my scanner, and then I show up late and I miss my entry and I don't get a good trade, and it just pisses me off and frustrates me. So I'd rather anticipate a trade opportunity, be prepared to get into a trade, and then take the trade. Well, guys, it's almost 2 o'clock. So if you want to start getting into your Thinkorswim questions, if you're struggling with Thinkorswim or have problems with it, this is your day. COT, What is COT? Yeah, I can save this as a separate video. Let me just kill